Latin American markets have been amongst the weakest in global emerging markets through 2013 and coming into 2014. The Brazilian market has struggled with the consumer demand environment, rising inflation, and as a result of that, rising interest rates. And whilst in Mexico there's been much more investor optimism, the macro environment has remained challenging in spite of the reform agenda which has been announced for 2014 and 2015. Latin American markets have seen significant currency depreciation, Brazil in particular, but also the more recent currency crisis in Argentina. We've seen investors taking money out of the market, which has exacerbated concerns over US tapering and overall growth concerns in the region. We're not unduly concerned. We believe it's part of a restructuring of the market, particularly in Brazil. And in Argentina, there's very little contagion to the rest of the region, although it has seriously impacted sentiment. In real terms, there's very little impact on the rest of Latin America. For the long term, we're much more optimistic. Our core investment case for investing in Latin America remains unchanged. Latin American markets remain very attractive from an income perspective. Latin American markets are very much in the growth and development phase, and as companies and governments become more like their developed market counterparts, we'll expect to see income on the equity side increase as investors are more focused on shareholder return and dividend yield in particular. There's a deep, broad pool of companies that are good quality, well managed, and can generate great earnings, particularly in that consumer space that we're particularly interested in and that we believe will drive long-term growth in Latin America. Latin American fixed income in the local space remains very much a yield story, particularly in the Brazilian market where real yields are around 7%. And that kind of yield is really only available in frontier markets elsewhere in the world.